Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, today Mena and I would like to talk about changing your billing structure. And really what we want to do is have a business that has a very predictable level of cash flow so that it helps you with planning whilst also trying to match expenses and revenue. And we've talked about cash conversion cycle previously, which is really the number of days between paying for goods and receiving the revenue. If you're a consulting business, paying for goods is salaries, of course. If you're in manufacturing, of course, it's raw materials, these sorts of things. And so today, Mena, I want to talk about how do you approach that? How does it impact business, and why is this an important topic or factor to build into your business model?
So probably first thing off, I just wanted to sort of explain why a lot of businesses in their scaling phase fail when they're in sort of these project-based or sort of non-recurring billing sort of nature. And that's because it's really hard to sort of predict what kind of output they require, because they could be a cyclical business where, around Christmas time, for example, they're the busiest ever, and then during winter months, they're extremely quiet, but they're employing staff throughout. And without sort of pipeline or understanding of that pipeline, it creates a lot of hesitation and underinvestment in the business. And what can end up happening is that your product or service falls short. So it's really important to scope out that creep and understand that margin leakage beforehand before you actually come up with your pricing structure and your billing routines. So I guess what's important here in these types of businesses is to establish a payment cadence. So, the common things that we try to do with our clients is to basically fall into one of four categories. And that's either subscriptions, retainers, milestones, or usage. And the first one's pretty self-explanatory, being subscriptions, is if you're sort of getting a regular service or providing a regular product to a client, then you would anticipate that there should be some sort of weekly, fortnightly, or monthly billing involved. The next one is around retainers. Now, for any professional services firms, for example, if you're sort of regularly engaging them, it's not uncommon for you to be on a retainer arrangement. So think about your solicitors or your accountants or financial planners or even architects, for example. If you're constantly going back to them for advice or seeking out some sort of service, then there needs to be some sort of funds available in their account that they can draw on as the work progresses. So that way you're not sort of chasing bills and you've always got that cash flow there ready for you. The next one is milestones. Now, for a lot of project-based work or even product-based work, there could be a big lead time on delivery. So, there could be certain KPIs in place. So think of a construction contract, for example. In a construction contract, you would pay progress payments for each particular stage, whether it be at the foundation stage, whether it be where the slabs are poured or where the frames are up or where you're at lockup or so forth. At least at that point in time, the builder is actually getting paid for the work that they've actually completed for that particular stage. You're not forking out $1 to $2 million at completion, but you're progressively getting paid. Now, the final one's around usage, and there's not a lot of businesses that fall into this category, but there's some businesses that, such as if you think about the likes of Dropbox, for example, you pay for as much as you use, as much storage as you take. It's not just a subscription model, but you pay for, if you want 1 gigabyte or 1 terabyte or whatever it is, you pay for that amount upfront and based on what you use. So it's really important to determine what type of business you're in and how you can sort of educate your clients or customers to basically give you more upfront to protect your workflow and your optimization of your business.
So those different business models or pricing models can be really valuable. As I said at the beginning of the introduction, what you're trying to do is match your revenue with your expenses, because as a business scales, if it's got a long cash conversion cycle, it's just going to need more and more cash to be able to scale that business. Whereas if you've got a negative cash cycle, that is that you receive your revenue before you need to pay for your expenses, the business is self-funding. Also, from a investment perspective, again, to grow a business, it can certainly help. So that's where subscription works really well for technology businesses. I mean, it doesn't initially until they get scale, but once they've got scale, allows them to reinvest in their business knowing that they've got some certainty on what their cash flows look like. And also, it's a very scalable business. And once you've built the software, you may as well sell it many, many, many times because each additional time is almost all profit, net of marketing expenses, of course. So the challenge then as business owners is we need to really think about how can we create ongoing value? How can we design a product that means that we're going to deliver value to our customers at regular intervals? Now, if you've got a product style business, that can be a little bit easier. If you've got a business that really is more of a consulting style business, that can be more challenging. But all these decisions kind of feed into each other because you've got to have a sort of clear target market and target audience. And then what you want to do is design a product that really is highly desired by that target market and target audience, and then design that product around the pricing model that you'd like to achieve. And quite often business owners, they're not really great at, pricing, firstly, and we've spoken about that previously in this podcast, and not really great at bucking conventional wisdom. Not always. So quite often, if we're used to just billing the client at the end of the project, quite often we'll see that there's sort of psychological pushback from business owners say, oh, this is the way I've always done it. Will my clients be happy with that? Will it upset them? Does it create a difficult conversation? It might. Yes might be the answer to some of those questions. But the thing is, what you're trying to do is build a robust and sustainable business. Hopefully one that scales and hopefully one that scales without costing cash flow. And at the end of the day, what is best for your clients is that you're in a position where you're able to reinvest in your product and service and business so that their experience just increases or improves each year as well. Exactly what we try and do at Pro Solution. What we're doing today, hopefully 5 years from now, we'll look back and go, that's not that good. We want to be much, much better in 5 years from now, for example. Well, we can't do that if we're always worried about cash flow or, if we don't have the cash flow to be able to reinvest in training staff and hiring new great people and building out better products and all these sorts of things.
So I think the next step is to then ascertain how tax and GST works with this sort of revenue. Now, if you're billing on a retainer, that doesn't necessarily or equate to actual profit for your business, because that means that that retainer could be actually recalled upon by your client at any point in time because the services actually haven't been rendered. So it's really important to actually recognize this correctly in your financial accounts. It should be recognized as unearned revenue in your balance sheet. So you're not unnecessarily paying income tax or GST up front for work that you actually haven't actually rendered and is somewhat at risk as well. So it's really important to align your accounting and tax treatment correctly so it doesn't affect your cash flow.
So in addition to the taxation matters, there's a few other things that you want to think about if you're going to roll out a reoccurring revenue or billing strategy. The first one is that you want to have a clear metric on churn. So it's great to sign people up onto ongoing sort of revenue contracts. But if you're losing them after a couple of, just a few months, you really want to learn about that. So cancellations, downgrades, non-renewals, these are things that are important that need to be tracked. And an excellent example of this is gyms. I mean, gyms typically work on a subscription basis. They'll have a very clear idea of, the average length of a subscription, so how long people stay, for example, a member of that gym. And then they'll have a churn rate. And that's very common in that industry to have those metrics. And so we can learn from that as business owners. Of course, we want to have very similar metrics. And what gets measured gets done, or what gets measured gets improved. So we want to have KPIs on those sorts of things. So if you're going to roll out a reoccurring revenue strategy, then it's very important to understand what your churn rate is and have the management process of monitoring that. The other thing we want to talk about also is how to implement a reoccurring revenue strategy. So you don't necessarily, you could, for example, go and contact every single customer or client that you have and change the arrangements all in one foul swoop. Now, that's possible, but I would say that, Jim Collins always talks about firing bullets, then firing cannonballs. So I think the first thing you want to do if you're going to implement a different billing strategy is do it with a few clients first. Get their feedback, iterate, make sure that your communication around that process demonstrates, the advantages for the customer. Ultimately, you want to sell it as something that helps you help them in a better way. And then once you've bedded it down, that's when you might sort of roll it out across the board. So I would have a way of tracking that. You can do that through Xero or your accounting software in terms of recognizing how much revenue is coming through a reoccurring model versus, your old legacy sort of billing models. But it's really about taking a staged approach. The final tip is reduce the pain of paying. So there's a bit of research. Dan Riley has written a few books about, he's a social scientist, and they talk about, he sort of coined the term, the pain of paying. And really the whole idea is it's painful for us to pay. It's the most painful to pay in cash. It's less painful to pay electronically. And in fact, the biggest insight to the research is a little bit off topic, but if you prepay for your holiday, it's proven that the enjoyment you get from that holiday is vastly improved. So paying up front is just one little tip there to get better value from your holiday, of course. But what you want to try and do is reduce the friction and reduce that pain of paying. And that's something I think, Amazon introduced its one-click buying process. I mean, if you think about how online shopping carts worked, maybe 10 or 15 years ago, they were really, really clunky, really slow, and they weren't that easy to use. Now, these days, particularly with, vendors that use Stripe, for instance, it can be super quick. It remembers your delivery address, all those sorts of things. So that's what you want to try and achieve in your business as well, and particularly around a reoccurring model. You don't want your customers necessarily to have to pay every invoice manually. That just increases the pain of paying. So if you can automate the billing process, you will find that you'll have less friction and your churn rate will also reduce as well. And there's plenty of ways you can do that online now, particularly using Xero, to make that process as nice, as simple and easy as possible. So I think the key takeaway here is to really think about your expenses and revenue, think about your cash conversion cycle, and think about how much cash does your business burn or contribute as it scales. And ultimately what you want is you want a positive cash flow business because that doesn't take any additional investment to scale. And you want hopefully predictable revenue so you don't have, so you can know, for example, this month you've got a high level of confidence what that revenue income is going to look like. And you're matching revenue with expenses again means you're not putting your hand in your pocket and paying out expenses before you get income. So they're the key metrics to think about, and the one solution to it could possibly be some sort of reoccurring billing model. Okay, we'll leave it for this week. Until next week, bye for now.